Imagine knowing when it was time to actually worry about the market topping or bottoming, depending on the time frame you're in, before it happens. So you're not caught off guard like other traders. You're actually ahead of the game. You're prepared for what's going to happen. In today's video, I'm going to show you how I use market regimes to spot major market tops and bottoms, giving you the tools to time your trades with precision and avoid just getting caught up in the ridiculous idea of trying to short a market that goes up and up and up and up and up and up almost perpetually. There's a time. If you're tired of chasing it, this strategy could help you get that part figured out. Okay. What's up, everybody? Chris over here. I'm the founder of Pollinate Trading. And I'm all about real robust trading edges in the market. If you're looking for actionable trading insights, not just fluff, hit that like button, subscribe, and go to pollinatetrading.com. You can subscribe to the newsletter. It's free. I give some pretty good insights in there, I believe. Today, we're diving into how you can use market regimes to identify major market tops and the bottoms. And we're going to use my favorite tool for that, the SQN indicator. I'll break it down step by step so you can start using the tool right away. So let me share my screen with you, and we can take a look together. All right, you'll see we are looking at the S&P 500 on a daily chart. Up here, we have two moving averages. This is actually really good too to help you identify when to market regimes as well. But we're gonna focus on this one down here. This is the SQN tool. Okay, again, this is completely free. Go to if you're on TradingView, just search for SQN. You should see Christy Fallible. Back when I used to do videos with the Fallible channel. Christy Macro is what my name is on there. There's over 300, looks like 300 and something people have boosted it. So it's the one with the most boosts on it. It's not a super common indicator. That's why, and lucky for us, right? That's why it's not like widely used here. You can go and look in TradingView. And there's not a lot of these SQN tools around. People just don't use it. Okay, so back to our chart. Now, this is a daily chart, and the way, let me just make sure our setups are here. So the standard setting here is a 100 period SQN, and that will give you a really good breakdown. So that is about 5 months worth of trading data. And the way this indicator works is it basically averages the close to close. So yesterday's closing price to today's closing price, the difference. It creates a simple moving average of that over the last 100 period. And so it will give you direction. You'll see that it's going up. The histogram goes up and it goes down. And the higher it goes up, the more volatile, the more toppy, the more crazy a market is. The more it's in this green area, actually, that's a lot more calm and not super indicative of a market being in trouble. Now, what I want to look at here is I want to go back and look at how often we see it. So getting down into the underside of it, this yellow or maybe light green is actually neutral. Okay, so it's bearish neutral when it's below, it's bullish neutral when it's up. That's mostly transition area. Those are not as indicative. Definitely not. When they're negative, they're indicative of a bottom. But this moving around within that side mostly just shows you sideways stuff. So let's take a look at, well, buying dips. Okay, you can see that we had a dip to be bought in March of 2020. We had a dip to be bought in December of 2018. That was a big sell-off. S&P sold off 19.9% from September to December. Geez, I forgot exactly how far it went down. It went down 35% in about 3 weeks. That was a big one. And you could have been given a clue that would have been the general area where you want to start looking to buy a dip. over here in the summer of 2022, it actually was the most prolonged we'd seen in a long time. So it was a lot harder. This one was actually the year of 2022. If you were trading in 2022, it was a lot harder than trying to, believe it or not, catch the bottom here. We get into the 2016 period. It was rocky. It was prolonged. Like we topped in the summer of 2015, and we didn't get going again until the summer of so for like a whole year. 2016 is when it kicked off, and when that kicked off, that just took off. Now there's basically two places that this is the global financial crisis. Okay, there's a couple of, yeah, we're all the way back to the 9/11 and the recession. You can see that we're jumping decades, nearly decades, or at least a number of years before you actually get something down into a bear market type of environment. And you'll spend, so this is 1994 from 1991, so three years or so of just straight up. We had a dip in 1990, and then another, so 87 from the bottom there to 90. So 3 years of up before we had a pullback. This was the 80s was actually kind of crazy. So it was 87 is when the big crash happened. Little bit here in 86, a little bit here in 85. 84 was kind of the thing. So generally speaking, this 84 to 87, 3 year pump. You can see that the down markets are few and far between. Even historically, 70s were a lot more. You can see that was the decade where actually there was a lot more downside. 50%. What is that draw? I mean, that was a global financial crisis sort of thing. Yeah, 50% sell off. So what you see is what we're talking about here is a market top and a market bottom. Okay, so for our market tops, there's one thing that gives me the idea that a market top is available. Just because it actually prints blue doesn't mean that that's a market top, okay? There's other things that we'll do to kind of put it all together and identify market tops. But most importantly, it is available. And that's the key word here. We're talking about market regimes. We're going deep on market regimes. This means that a major market top is available. Somebody's offering it for sale. If nobody buys it or sells it, then it doesn't mean it's going to happen. And we saw that here in April of 2024. Okay, it was very frothy. And so let's take a look at what it did. You can see it was just straight up. We could draw this trend line here, and you can see that it's just perpetual, right? That went from December at about the breakout of 4,500 to a high of 50. We'll call it 5,250. So 700 points on the S&P 500, almost directly. Now, it wasn't a straight shot. There was some drama here, like looking back, you forget about all those days that were like, ugh. But, as we examine it more, you can see that it was just perpetually in this really strong uptrend. So now, if I put the futures up here, let's look at the futures and see comparatively, because that'll give us the 24-hour trading of the day. Now it just looks like it's just, so you can see that the move happened steadily. So it's like a big move and then a number of days where it just grinds higher. Big move, pulls back. Okay, that's how you're going to build this. Okay, that's how, if this is going higher, this is going to go higher. So we had a 2% up move. Prior to that, it was like a 1%, like you're starting to get bigger up moves here, bigger percent up moves, more 2% up moves in this area over here than down in here. Okay. So the way a market, when after you bottom and you blast higher, you're going to get these big thrusts down in here. A thrust off the low is huge. 2%, 1.5%, 1%, 2%, 1%. Like this was just like a week of just bam, maybe 2 weeks of just straight pounding. Little consolidation through December, and then off to the highs right about at the 1st of April. So that's 3.5 months of almost weekly, at least, if not daily, new all-time highs. That should be an indicator, one, that things are a little up there. But the thing is people, traders, tend to, let's see if we can find our all-time high breakout. Okay. So all-time high breakout from the 21 high was here, 4,800. Okay. Now, the thing is notice how we kept trying to put in new all-time highs. Betting against a new all-time high on the S&P 500 is a ridiculous. That would have been December 2021. This is December. For 2 whole years. For 2 whole years, it did not put in a new all-time high. If I back up my chart, you can see that the times that it spends putting in new all-time highs, so you can see like historically all the way back to the beginning, it has spent more time putting in all-time highs than it has doing anything else, really. So what we're looking at here is this battle to put in new all-time highs in December and January. I'm going to go out on a limb and say, first of all, notice what the market regime was in. It was still very quiet. There was no volatility. It was still pretty, like, we had already worn out a bunch. We went big power move from the 2020 lows up till there. And then we just went sideways for 2 years to absorb that price level. Once it got there, it was the people that were attempting to short this area, thinking that this was the market top and we were going into another market down move and all that sort of stuff. Don't know how to look at a chart that goes up perpetually. There's things behind it that economically that are just going to force it to go higher. Okay, money printing, yes, burr. So it was inevitable to put in new all-time highs. Now, when it's putting in new all-time highs, when your market regime, the SQN, is in a quiet period, it's almost inevitable that you're going to get new all-time highs. And if you're betting against it, I can tell you that the instances that a major market top has ever happened and the SQN didn't put in a bull volatile reading are 0. But also notice that just because it does it doesn't mean that it is anything but or that it isn't that it's inevitable. It is not inevitable that it's going to put in a new that it's going to be the major market top. It just means that the environment is available for a major market top. Now notice what happened. This was March 2024. We finally peak at 53.30 something or whatever, and we pull back for the beginning of April for looks like 3 weeks. And then we really don't fully do the new all-time high until June. So from March till June, you've got, again, sideways action. This was a pullback of a 7%. So that was a 7% pullback. When I'm talking about market tops that are worth participating in, that is shorting, finding a place to get short, I consider market tops to be reversals off of a market top. I consider 7, 8, 10% to be a pretty good number, and that's what happened. We got 7% here, and we also spent 3 months before we actually kind of took off again. Okay, notice that we were back into the bull quiet, and instantly we got bull volatile. Like within breaking out, within a few days of breaking out, we went right back into bull volatile. So from when when you're at 1.59 on green, that's still considered quiet. When it goes to 1.6, now give or take a point or two there or whatever, but notice that it's at the highs for almost that entire period. So again, this is telling us that a major market top is available, even if we just printed 1 day of it. The other thing is we're at the 150 level pretty almost steadily so from April to our next top in July. So May, June, another 3 months. We get a pretty decent top up here at the midpoint of July. And as that happens, we got another pullback of, this time it was 10.5%. Okay. This, by the way, all of our systems were long, and then we exited. I had like 10%, 90% cash. 10% of my capital was in the market. I was able to buy, catch that move, some of this move, caught this move, and then reversed and went long. And again, now let's look at how the market regimes are going to give us that indication of where we are. 162, it didn't print the full day, didn't print bull volatile, but that's pretty close to bull volatile. It's not there. So what does that mean? I'm not too worried about a major market top happening right now. What is going on in the world right now? World War III. We've got, war in Europe. We've got war in the Middle East, multiple countries in the Middle East, 2+ in Europe. We've got a presidential election that has already been 1.5 assassination attempts on just one of the candidates here in the United States. We have interest rates are dropping because of fear of recessions. We've got oil ripping. We have China equity market ripping. It's volatile. It's a volatile place at the very moment. And, it's the fourth quarter, beginning of the fourth quarter of the year right now. Fear's the thing that made this thing break out. Everybody was fearful that was a double top, and it wasn't actually going to, for some reason, everybody thought that once it got back to the high, it was going to give it up again. So this was just a fear. People that, like us in the lab, we were long, we were fine. People were scared to buy because it was new all-time highs. It had never been that high before. People were scared to buy. And then eventually they had to chase it. And the thing that happens is eventually, like, the last buyers come in. When the last buyer when you are convinced that, well, I have to buy it now because it just doesn't stop going up, that's the point that it stops going up. Ask me how I know. I've done it a couple million times myself. I'm teaching you years and years of experience here. So, we could find these spots all over, but that's what we're looking for. We're looking for the opportunity for a major market top. And the structure of it is that it is fragile. That's what causes bull volatile, because the moves are so big and it's been going, it's so far away from its mean, its, actual value. It's so far away that it is pure speculation. And so it's highly speculative at peaks. Okay. And as it's going down, dip buyers are speculating and speculating and speculating and speculating. Sometimes they're right. Usually what happens is everybody's scared to death at the bottom. Everybody's super bullish right here. And those things are the things that get you in trouble. So anytime you're thinking to yourself, now understand that this is, if you're looking at Euro USD, for example, if we want to take a look at some Forex stuff, this is a lot more spread out. Look how many times this thing goes into the bear and stays in the bear, goes into the bull, and these moves happen and then they reverse quite a bit. So if, let's take a look at the Euro. It's not a trending sort of thing. It launched, it went live, it became a real asset right here. So it was the only currency in Europe right at that, basically right there. So it was still kind of part of something, but it wasn't real until right there. This is going back to the year 2000 is when it started trading. So you can see that the euro is currently at exactly what it was back in when it started trading. It's exactly where it was. So trying to apply these same sort of principles to currencies is a little different. Whereas if cryptocurrencies are different than currencies, commodities are different than equities. Like everything has its own different thing to trade. That's how we pick major market tops. Now, when and I'm talking about the S&P 500 specifically here, you can do it in NASDAQ as well. It's interesting to look at NASDAQ right now because it has underperformed on the downside. Okay. When this gets, first of all, when it goes negative, that's your first warning that there is a potential for a bottom. It took a while to bottom. This was not like, this just told you that there will be a bottom, right? This one thing I'll tell you is there will be an end to the selling. It's just when will it happen? It really wasn't useful. Here it actually was. February 16th kind of was the bottom. So it gave you that signal and wow, it went. I do not like to time it like that. I personally say, okay, when we get below the zero line, I want to start thinking about it getting bought back up. It worked really well. Almost the same time that it went red, it turned on a dime. You go from 1,700 on NASDAQ to 2,300. So a 50% move almost. Pretty much directly from the actual moment that it printed. But especially let's look at the global financial crisis here. It was April 2009 till September 2008. So 6 months in that bottom area, followed by which it had already done another. So actually January to April. So almost like 15 months, 16 months of being in that area. There was some hope up here, but it never panned out. There was our peak. Now, the final thing, and I'll do a video on this one probably tomorrow, where we use the SQN to size our position. The other thing you can do is ATR for sizing your position. The ATR, average to range. So the way you use it to size your position is when the higher your SQN is, then the lower your position size should be. Same with ATR. So today, let's for example, let's say I have a $100,000 account and then divided by ATR. And the ATR is 342 right now. So 123 divided by 342 is 292 contracts. So portfolio value divided by ATR times, what's your percent risk? Let's just say 1% equals 2.92 contracts. Okay. So you can see that if I was to take a trade right here, if I was to go long and I was willing to risk 1% with a volatility adjusted position size, then I would easily get that figured out. Let's take a look when ATR was at 540. That's 185 contracts at 1% is 1.85 contracts. So I would have, during this high volatile area, I would have bought, about half as many S&P here as I would today. So today I would be buying more because volatility is declining. Okay. Same with SQN. You could, with a rising SQN, the lower it is, your calculation would be different because this is considered at low levels. This is considered lower risk. This would be higher risk. So your size as price goes up is going down. With the ATR, it's just as volatility is going up, size is going down. So that's how you would, that's how I would do it. So this tells me clear green bull season, just be long in the market, look for opportunities to be long. This right here is a classic setup right here. So today would have been a long entry, buy above the high. High was 2113.75, so 2114. Okay, stops down in here somewhere, and you're running three big NASDAQ contracts on this to your next level. That's just how we're good. Okay, so covered a lot today. If you're a day trader, how do you use this? That's mostly swing trading, right? If you're a day trader, how do you use this? We talked about it in the how not to buy a falling knife. When you're in this bull quiet area, you're looking to be buying the dips. So let's take a look today at the market. Okay, our daily chart told us. Okay, let's go regular trading hours even. We don't even need to pay attention. Our regular chart, our daily chart is in bull quiet, right? So dips can be bought. That is like the easiest thing in the world to know what to do. If you were to come back today at the end of the day and say, when was the best time to buy? Like, it's obviously right here. Of course, you would say that was the best time to buy. I would say the same. This is the area I would have been looking because we are in a bull quiet and we got the curvy formation. Curvy would have put us long right here. So we would have gotten long right there, could have sold there, or you could just write it out to the end of the day. Knowing that we're in bull quiet, the likelihood that you're going to get a candle that is going to open up here and close near that level is about 70%. So you can easily see that, you know, your risk, you were never hit. Where is long position? So the curvy strategy would have gotten long, put your stop right in there. And if you just held out to the end of the day, they would have got 3R on that. Okay. It's actually super simple. You could wear yourself out thinking that it's a super hard thing. And I talked about this earlier in the week in the video about how not to catch a falling knife. First thing, be in the appropriate market regime so that knife catching is available. Bull quiet, where we're at today, the green SQN is the place you want to be looking to buy those dips. These are not falling knives. These are dips to be bought. And you just have to have a plan of how you're going to do it, right? You could have absolutely put the, you know, somewhere near yesterday's close as a buying price and just put a market order in or a limit order in somewhere, you know, over there. Even if you bought the yesterday's high, you put a buy order in here somewhere, right? You still got a pretty good move. Now, what we do is we use curvy. We use our regular curvy strategy, the day trading strategy, pollinatetrading.com/curvy. And you just grab it right where it's supposed to be. And you either sell it 2R or you can adjust it for different conditions. With, you know, bull quiet market regime says you buy the weakness and you can write it into it getting near its opening price. It's not very often that it actually puts in new highs in a dip buying scenario unless there's really big news happening. And that wasn't the case today. This was a big NFP, non-farm payroll release that gapped it up. It gave it all away, and then it just drifted right back to where it's supposed to be. The world could have, everybody would have thought the world was ending right here. And then all of a sudden, so very simple. Doesn't take a rocket surgeon to figure this one out. But everybody makes it harder. All right, guys, we cover this in the lab all day. We're trading it all the time. PollinateTrading.com/lab. You can join us there. And if you want a day trading strategy to really take advantage of these sort of moves, Curvy is excellent for that. And if you just want to do the swing trading stuff, the Swing Beast is built all around. They're all built around the market regimes.